Hey everybody, Marty Missouri here. It is February 2nd, 2024, Friday with your weekly economic update. Going to spend the bulk of the economic monologue on the labor market because we got a barn burner of a jobs number today. So I want to get into the weeds a bit on that and kind of share with you the below the surface reality in that jobs number and some other related statistics. But first, speaking of barn burners, given the huge move, I think, in the major averages today for equities, I thought we'd go ahead and combine a quick market snapshot with the economic update. I want to start with the stock market. So, folks, we'll look at the S&P, we'll look at the NASDAQ 100, we'll look at the Russell, yields, and the dollar really quick, like we always do. We will take a look at market breadth, and you'll know why here as I get into the conversation. But again, I want to keep that part quick because it's the economic stuff that I think is more relevant right here. Not that today's move in the market was irrelevant. Now remember, folks, right here, breaking out below a rising wedge pattern is your sell signal. The wedge pattern in itself and the bearish divergence is not, from a technical perspective, the way we see it. So you had that big down candle here. Yesterday I did a video for you when we were about halfway up this candle. Again, I said do not be surprised. In fact, it would make sense, technically speaking, if we come back and test the uptrend line right here. And folks, looks like we closed literally right on it today. So even though today's move was dramatic, surprising, beat my expectations for sure, S&P was up like 1% today, it still just did technically what is not unusual. So if this pattern and this sell signal is legit, this is what we should see over the next few days, right? If it's not legit and this is a failed breakout, nothing worse or maybe better in this case than a failed breakout. And then we just keep kind of melting our way further into all-time high territories, which would be very much at odds in what we're seeing in the charts across just about any time frame right here. We've got to burn through these divergences before we could get technically bullish. On the NASDAQ 100, essentially the same thing. And remember I said it, and that's exactly what happened. We came up and we stopped right on the uptrend line right here. Still have your bearish divergences, virtually a little tiny buy signal right there, but yeah, as you know, folks, it's these divergences and the slope of the momentum indicators that we're looking at. And this looks too much like other tops. Looks like this one back here, right? And of course, it looks like the one at the previous all-time high, which I've shown you plenty of times of late. Russell 2000, time before last, I said I was a little more constructive on that one. It actually closed down 0.5% today. That looks like an up candle, but essentially it gapped down and made its way back during the day, but you can see it was still below the previous day's close, right? Did find very stiff support, just like a pogo stick, right off of the 50-day moving average yesterday. That's not bearish. That shows a sign of support there. Do see that we're breaking down here off of these attempts to get through that year-long, probably longer than that, resistance line right there. Nothing real encouraging going on here. Still a sell signal on the MACD and still rolling over off of overbought territory on the RSI. So remember, I keep suggesting that we're still in that mode where stocks and bonds or bond yields will go in different directions. And I said, as long as this keeps going down, that continues to be bullish for stocks. Well, look what happened today on that uber strong jobs number. Bonds utterly tanked, yields went up notably, but stocks went up too, right? Or did they? And I'll answer that question here in a second. And then the dollar, same thing, right? Correlation has been strong dollar, weak stocks. Well, look at that dollar candle today, folks. That's quite the engulfing candle. I mean, that thing actually does engulf the last 1, 2, 3, I don't know, multiple days. That is extremely bullish from a candle pattern perspective. So that suggests that the dollar has yet higher to go. Despite what it looks like in the major averages today, I still have to believe that's bearish for stocks right here. So I just kind of sarcastically said, or did they? Or did stocks really go up today? Well, obviously, certain stocks did. But when you look at market breadth, right, the S&P 500, well, let's start with the Dow. Dow was up I think it was up like 200 points. I don't really look at the Dow much. But 16 of the Dow 30 actually declined today. So the Dow was up a chunk, and more than half were actually down. Where it's really noticeable is the S&P 500, like I said, was up over 1% today. 276, more than half of them were actually down on the day. Early on this morning when the market was ramping up, something like 70%, 70+%, I featured it on the written note, were actually down. And then on the NASDAQ, which really had a good day today, headline, call it 1,800 of them, and just over 1,000 were up. So 1,796 were actually down on the day. So, I mean, again, this speaks to that really nasty breadth. And that is not, and I can't emphasize this enough, and this comes from history and from experience, that is not a healthy market setup that you want to chase right here. And just another way to look at it. Here was the market early on. This is the S&P 500 E-mini futures contract. So I can run this one to show you what happened in the pre-market. So here is here is the jobs announcement, and this is what exaggerated that arrow, but you can get it. This is what the S&P did, and then this is the cash session. So this is when things opened up. But you can see it climbed out of it. Now remember, the market was still digesting all the hoopla, raised price targets for your Meta and your Amazon and all that sort of thing. And I looked at Amazon's short interest. It was relatively high relative to where it's been. So unequivocally, there was a ton of short covering today. That really caught people offside. So anybody who thinks this is some big fundamental move, at least for an Amazon, while their numbers were good and their AWS services and all that were good, I'm not saying that things are ugly for Amazon or that Amazon is a sell right here. Amazon would be a sell in a recession scenario, I can virtually assure you. And when you look at them from a current valuation standpoint compared to where they normally trade, even when you look at the improved forward outlook, they still are historically expensive right here. So that's a vulnerable stock that could completely and utterly continue to go higher right here. But again, if you're a thoughtful long-term investor that looks at fundamentals, probably don't want to chase that. But if you're a trader looking at momentum, hey, I wouldn't blame you. And then, of course, there's a lot of derivatives, a lot of options action going on where people buy calls, the calls ramp up, and then the dealers who are short those calls, the ones who sell them, got to buy the underlying. And this is kind of your GameStop scenario now. There's no other comparison between an Amazon or a Meta and a GameStop from a company character, earnings, that sort of thing perspective. I'm just saying from the underlying options action, if the dealers are caught offside and things go against them, they're going to have to buy like mad to hedge that position so they don't lose too much. And then, of course, with Meta, you had really good numbers. Then you had an increase to the dividend, and you had a $50 billion share buyback. That's just begging the world to buy Meta stock. And one of the macro strategists who I admire the most, he's coined the statement that CEOs these days have become nothing more than shepherds of their stock prices. So he said the first thing to go as earnings are beginning to go would be jobs. And we've seen, had to be 100 or 200,000, I think, just in the last 2 or 3 weeks, layoff announcements. A lot of that in the tech sector as well. So if you have the cash, you can do the share buyback, and you want to hold your stock up right here as well as lay off people to improve the numbers, you're going to do that. And I don't mean to sound like such a skeptic, folks. I just want to articulate what tops look like, tops in the economy, tops in the markets, and so on. but tops are difficult. They are choppy. They can take a long time. Once they give up the ghost, it can be quite dramatic to the downside. What do they say? They take the escalator up and the elevator down. And I'm not promising that there is an elevator down scenario in our near-term future. I'm just saying the risk remains very high, and there's nothing about today's action that changes that. So these four here, again, in the cash session, are the NASDAQ comp up 1.74%, the S&P up 1.07%, the S&P equal weight down 8 basis points, and the Russell 2000 down 59 basis points. So equal weight is going to give you equal weighting of the S&Ps, and we saw that, right? We know that a good chunk of them were down today, more down than up, so this makes sense. Russell 2000, 2,000 companies, they're small companies, was actually down a fair piece today. So again, so this just talks about how ugly the breath was, and how, while the media is certainly pounding the table and celebrating these all-time highs, I've shown you enough already. The average stock isn't. I think 7 down sectors and 4 up sectors since the early 2022 high and so forth. So just want to make sure we accurately depict what's happening here. Lastly, on the market, I just noticed this week that the bulls are back. So remember, this is that the green line is the American Association of Individual Investors bullish sentiment. The red line is the bearish sentiment. This is heading into that 27% decline here in 2022. Bull side of the boat was very crowded. The bears side was very crowded heading into 2023, and that was bullish. And we are historically out over our skis on the bull side of the boat. That came down as things began to come down, and it just came ramping right back up. So you can just go back and you can chart these things, folks. Hasn't happened here, right? But you just basically kind of draw these lines, right? When you get these kind of P's, and you see bullish sentiment ramp up and then drop back down, right? This is the kind of action you tend to get. So that's why people who trade sentiment have great conviction, is because history gives them that conviction. Really, nothing really happened on that one, just a little bit of a downdraft. So again, folks, just more evidence that we're maybe skating on a little bit of thin ice right here. For whatever reason, the investor intelligence page wouldn't load. I looked at that this week. The bull-bear spread is at 40, which is right there in the high end of the danger zone there too. And all that means is that people are maybe getting out over their skis bullishly. Doesn't mean we can't stay up there for quite some time. Doesn't mean that that we need to get a significant sell-off. It just means that you'd want to check that box in terms of not your ideal setup relative to sentiment right here. The jobs number, okay? We expected like 184,000, and we got over 300,000 for December. Very impressive. In the morning note, I said, folks, and this is a lagging indicator, the jobs number. No ifs, ands, or buts about it. It's December, and we got upward revisions for the prior 2 months. The leading indicators are things like job openings, the quits rate, and the jobless claims. I'll show you again, but we just went over those the other day. So once again, I'm going to paraphrase Peter Bookvar. He's a economist / strategist whose work is worth paying for, among others who we contract with to just kind of hear their perspective and look at their data and their analyses. Here's what he had to say, and I'm going to paraphrase about this morning's job results, and I think I agree with him across the board. He titles it, "Can We Be Even More Confused?" Well, ADP, the payroll service, on Wednesday said 107,000 private sector jobs were created in January. The Bureau of Labor Statistics said, never mind, it was 317,000, and with a headline print of 353. Okay, so private sector, 317. The 2 prior months were revised up by a combined 126,000. Now, the household survey, right, where this comes out of households as opposed to employers, they said 31,000 jobs were lost, and the size of the labor force shrunk by 175,000, thus keeping the unemployment rate unchanged at 3.7%. The U6 rate, which you can call it the all-in rate, discouraged workers, part-time workers who want to work full-time, that actually rose a tenth to 7.2%. And there were increases in, quote, slack work and can't find full-time commentary. If there was a big offset and a fly in the ointment to the large headline upside, it was hours worked tanked to 34.1. Outside of COVID, that's the lowest since 2010, which means each worker is being used less on average. Average hour earnings were up by 0.6% month over month, double the estimate, but with people working less hours. Of course, the average jumped. Average weekly earnings saw no change month on month. The service sector, job gains were driven by private education/health, rising by 112,000. Government added 36,000. Professional and business services hired a net 74,000. Job growth cooled, interestingly, for leisure and hospitality, adding just 11,000, and retail added 45,000. On the good side, manufacturing hired a net 23, which is absolutely at odds with all the employment components of all manufacturing surveys. Construction added 11,000, while mining shed 6,000. Bottom line, he says, I wish I knew. The benchmark revisions and this large rate of hiring that doesn't square with anything I'm seeing in other hard and soft data makes this ever more confusing. Also, we have a 14-year low in hours worked outside of COVID, which is a big negative. I'm sure seasonal factors play into this too, and maybe there's some weirdness happening there. Wouldn't surprise me to see this get revised down considerably. And again, as I said on the morning note, folks, the leading indicators, which are the job openings, the jobless claims, again, just one more time, that picked up here notably. Continuing claims doesn't scale real well here. They had a notable impact as well. Those are leading indicators, so we'll see what this says going forward. The Kansas City Fed labor market conditions, right, rolling over. That's very much at odds with today's employment report. This is what it looks like. Before it rolls into recession, looks very similar to that. With regard to that manufacturing index, we'll get the services next week, which is the yellow line. But the white line, I will say, that's actually was an uptick. And I'll show you our graph. I forgot about that for the PWA index, but we're seeing some nice improvement there. And one of them was manufacturing. We're not in expansion territory just yet, but we're getting close. And so, if this came barreling back and then the services turned up, this would go a long ways towards negating our recession conversation that we've been having for, over a year now. So we'll see how that plays out. But I did read through the ISM report, and it's interesting to take in. Let me just pull that over. So here's where they just kind of summarize their components. Again, the PMI itself, 49.1 from 47.1, so still contracting, but at a slower pace. New orders moved into expansion territory. That's impressive. Big jump from the previous month. Growing now, was contracting, so that's bullish. Production, 50.4. It's in expansion territory from 49.9. Now growing from contracting. Employment, however, and this is totally at odds with today's report, 47.1 is contracting at a faster pace. And we're seeing this across, as Bookvar said, across all of the manufacturing data. Supplier deliveries, 49.1 from 47. Inventories, 46.2, up from 43.9. Still contracting, but at a slower pace. Customer inventories, 43.7 from 48.1. Too low. Of course, if inventories are contracting, that ultimately could speak well for manufacturing as they restock, right, going forward. Prices, not good at all, and justifies Chairman Powell's hawkishness yesterday, 52.9 from 45.2. So now prices are back to increasing, and that's not good for bulls who are looking for, Fed help this year, from decreasing. Back orders down to 44.7, so that's negative, contracting at a faster pace. And then new export orders, 45.2, down from 49.9, contracting at a faster pace. So, and then imports, 50.1, that's up from 46.4, so that's growing from contracting. So overall economy still growing, now faster. Manufacturing sector still contracting, but I would say at a notably slower pace. So that's what took us from negative to neutral and helped our overall score in our index this last week. I'll just do one more, and that would be U.S. auto sales rolled over a bit right here. So you can see that, again, despite all the rosy news about the economy that showed up in the jobs number, and then we're digging down below, and maybe it's not quite as good as it looks right here. Disappointing auto sales this last month as well, and somewhat of a, who knows, maybe it's a consolidation, but we did break down below that line right there. Rate of change, negative 5%. And then lastly, our index score overall popped up again here to a 17, essentially 17.02. Still in the area where recession odds are too high for comfort, but definitely moving in the right direction. And we're back to July of last year levels. And so we're going to keep a very close eye on that, folks. If this were to continue and we were to move solidly into the positive here, and I think inflation is going to need to continue coming down for that to create a bullish scenario for, say, equities, the way they continue to trade, notwithstanding today. As I just showed you with manufacturing, as things get better, suddenly prices paid are beginning to increase. And of course, that will probably bleed through into the real economy as well. So folks, I will stop rambling there. Appreciate you all for hanging in there with me this long. Thank you for watching and listening. Much more to come. So much more I could comment on right here. So maybe I'll dribble more out to you over the next few days as I'm looking for content for the blog. Have a great weekend. Thanks again. Bye-bye.